So I think we have a problem. Retail investors are surging into the stock market in numbers that we've never seen before. Good for accessibility and those who truly want life-changing results, but bad for those who have no idea what they're doing and treating the stock market like a casino. There are ads for brokers absolutely all over the place that I've seen just on my outings over the course of the past couple of months, from FreeTrade ads down in London Underground to eToro ads at Villa Park to Crypto.com ads at Silverstone. It's literally all over the place. Now the thing is, I think it's absolutely great that people are being encouraged to invest their money because it gives them an opportunity, perhaps an opportunity that they've never had throughout the course of history, to actually actively invest their money and to grow their wealth over time. However, what I am concerned about is just the average run-of-the-mill investor actually getting hurt by investing in the stock market. The analogy which I've been thinking about is it's like giving a Formula One car to someone who hasn't even passed their driving test. The chances are, even if they're able just to get the thing going, within a couple of minutes they're probably going to end up crashing the car, which will inevitably cost a hell of a lot of money in repairs. And I fear that the same thing will happen to most retail investment portfolios because they simply don't know what they're doing. And look, I'm certainly not saying that that is for all retail investors. There will certainly be a large number of people out there who certainly have an investment strategy. They know and they have defined investment objectives. They know exactly what their risk appetite is, and they're making informed investment decisions based on all of the criteria in which they have. But let's be honest, we certainly know that's not the case for everybody. So in today's video, what I wanted to discuss is the three main reasons as to why I personally believe that retail investors are failing, and I'm also going to provide some solutions as to potentially how you can avoid that failure within your own investment portfolio. So let's kick things off by talking about the first core reason, which fundamentally comes down to a lack of investing knowledge. Some may argue that it was absolutely genius, others may argue it's absolute stupidity, but nonetheless, we all remember the kind of GameStop and AMC saga back at the start of last year, which very much started off the growth of meme investing. Now, whilst I'm certainly sure that some investors will have made money from investing into these meme stocks, other investors who had diamond hands will simply be sat now in a huge drawdown, with GameStop stock currently down 61% from all-time highs, and ironically AMC being down the exact same amount too. It was called the GameStop mania, and it was one of the core reasons that resulted in millions and millions of people signing up for trading apps to get a piece of the pie. And it probably comes as no surprise that there was a direct correlation between the engagement on Reddit's Wall Street Bets community, who are the architects behind this price manipulation, and the volume of signups on US brokerage apps like Robinhood. And I'm not going to lie guys, back in January, it was the biggest month I've ever had from affiliate link signups, from people literally just signing up to apps like Trading212 or FreeTrade to open their trading account. And if I'm honest, I think most people were probably enticed into the whole GameStop and AMC thing, as opposed to perhaps having a New Year's resolution to invest wisely into the stock market to grow their wealth over time. As a result, many retail investors fell victim to, I guess, what you could say is the modern pump and dump scheme, and as a result millions of dollars have been lost. So what's the solution to ensure that no retail investor falls for these traps in the future? Well, I certainly don't want to come across like a fun sponge here, so if you have got the appetite to invest into, I guess, some more speculative assets, then feel free to do so, but I'd only probably say allocate a very small percentage of your overall investment portfolio to that kind of activity. I certainly wouldn't make it my primary investment strategy in order to grow my wealth over time. So instead of focusing on meme stock investing, instead try and focus on the underlying fundamentals of the stock in which you're investing into. You should definitely be looking to understand valuation metrics. You should definitely be looking to analyze all three of the core financial statements of the business in which you're investing into. And it's also super important just to do some broader due diligence. Look at a business's investor relations website. Make sure that you understand the business and the strategic direction in which it's moving in. As well, don't be shy to go and actually read up and study and do a little bit more research on some other competitors within the space to understand how that alternative investment opportunity stacks up from a valuation standpoint. Because as Warren Buffett says, price is what you pay, but value is what you get. It all really comes down to the core understanding of the investment in which you've made and whether you can actually tell yourself that you've made an informed investment decision based on all of the research and all of the due diligence in which you've done. I would certainly say that you need to be spending at least a few hours researching and deep diving into the stock in which you're about to invest into before you put any of your hard-earned money at risk. It's simply not enough to go onto YouTube and watch a couple of YouTube videos, or even just go onto a Reddit forum and read the thoughts of some other stranger online. So with that said, now let's talk about the second major problem, which is investing behavior. There are so many different verticals to this topic, but I'm just going to try and address some of the common problems in which I see. The first and probably the main one is that investors more and more so now seem to be focusing on short-term results as opposed to long-term performance. According to a survey done by Charles Schwab, in 2020, 44% of new investors were focused on what they could earn in the short run. And this sentiment is certainly backed up by a survey which was posted on finder.com, who found that investors on average are holding onto their shares for just 0.8 years before going on to sell them, whereas in the 1980s, the average holding time was 9.7 years, representing a decline of 91.75%. It's where I'm kind of asking myself, what is actually driving this kind of behavior in the stock market? I think the reality is, back in the 1980s, there wasn't the volume of information coming at us at absolute lightning speed on a day-by-day, minute-by-minute basis in some cases, and as a result, it's made it very, very difficult for investors today to actually differentiate between the truth and just what's noise within the market. You've got media outlets, YouTubers, bloggers, and investing apps where investors are consuming content all day, every day, in order to find out what that next best investment is. And in my opinion, that's what's driving the wrong behavior. Investors certainly seem like they're on a path of finding out what the next hot stock is and then simply going on to sell the shares in which they currently have within their investment portfolio in pursuit of what could potentially be the next big thing. And I think that kind of shiny ball syndrome is probably what's going to have a very adverse effect on the long-term investment performance of most retail investment portfolios. And according to a 2020 report, 90% of professional investment managers failed to beat the average returns of the stock market by actively buying and selling stocks. In essence, trying to chase the next best investment. So if the experienced professional investor 9 times out of 10 is unsuccessful at just simply matching the overall rate of return of the stock market, then your average retail investor who's probably got limited levels of experience and probably knowledge is certainly going to be up against it. Which is where we probably should be talking about the solution, or perhaps I guess just reiterate the point of the importance of investing into the stock market for the long term. The rate of return of the S&P 500 over the course of the past 20 years is 307.81%. That's a compounded annual growth rate of 7.28% per year. If you're able to just consistently achieve those returns over the course of the long term, then you'll certainly protect yourself from inflation, and you'll definitely gradually grow your wealth over time as well. There's nothing particularly smart about just simply investing into like a Vanguard S&P 500 ETF, and just by doing that, you would outperform 90% of the investors within the market right now who simply failed to beat the average rate of return of the S&P 500. So no fancy investment strategies, no trying to chase the next hot stock to invest in. A simple investment into the S&P 500 is what Warren Buffett advises for the vast majority of retail investors. And then finally, we probably have the biggest problem for the retail investor, which is investing psychology. According to VanderTrack, the average retail investor has underperformed the S&P 500 by 11% in 2021, which, driven by the fact the S&P 500 has year-to-date returns of 26%, the way in which I interpret that is the average investor has been able to achieve an average rate of return of 15% this year, which is still pretty good, but when you compare that to the S&P 500 returns, then that's nearly 50% lower, just the average rate of return in which the stock market has offered you. So what is the reason for this vast underperformance? Well, simply a lot of it comes down to the tendency to make illogical and irrational decisions, which if you want to do a little bit more studying about, you can look up something called behavioral finance. In essence, the way that most investors behave is when the market is in an uptrend, investors are more inclined to actually invest into the market whilst the stock market is moving steadily higher. But I'm sure you've all heard the term buy the dip when the stock market is down. But unfortunately, this is where most investors do the exact opposite of buying the dip. And in actual fact, they go on to sell their shares instead because they're fearful that the stock market could continue to fall lower. Whereas the approach in which I take is when the stock market dips, that for me is an opportunity to begin to invest more money into the stock market to lower my average purchase price amongst many of the stocks in which I invest into. Now, the reason why I do this is because if I can lower my average purchase price, then over the course of the long term, my return on investment will be higher. Whereas in my opinion, it certainly looks like most investors are more comfortable riding the wave of unrealized gains when the stock market is moving higher. Whereas when the stock market takes a turn for the worse, which it always does and it always will do over specified periods of time, that's the point in time where a lot of investors get scared out of the market and sell all of their positions, which in my opinion is the wrong way to go about investing. There was an old quote, and I'm not too sure who said it, but be sure to let me know down in the comment section below if you know who came up with it. But it goes like this: stocks take the stairs up, but take the elevator down, which means typically speaking, gains are slow and steady and certainly take time. But when the stock market sells off, it does so in spectacular fashion, meaning you can literally have years worth of gains wiped out in just a matter of weeks. It's exactly what happened in the market crash of 2020, but instead of selling out of your positions because you were scared of absolute Armageddon hitting the stock market and that the stock market would just continue falling lower and lower and lower, instead it was actually one of the single best investment opportunities probably throughout the course of the past decade, because it's been one of the most explosive bull runs in which we've seen over the course of the past 18 months or so. It's all about flipping that investing psychology from fear to opportunity, because as Byron Rothschild once said, buy when there's blood on the streets, even if the blood is your own. And he's certainly right, because if you did do that during the market crash of 2020, then today you'd probably up well over 100%. So with that said, guys, be sure to let me know what your worst investing mistake is down in the comment section below. And if you did enjoy this video, guys, be sure to drop a like on it, subscribe to the channel if you're new around here. And with that being said, I'll see you over in the next video.